No pressure on Ben Thompson. I'm pretty sure you're all going to learn a lot now about the leveraged finance capital markets because he's the head of EMEA leveraged finance capital markets at JP Morgan. Really good to see you, sir. And of course, you're on the sidelines of the bank's high yield and leveraged finance conference. Well, look, I did ask the question to the viewers. So I'll ask it to you. Is your sector very, very concerned, trading quite a high beta, pretty much hair trigger on what the US Fed is doing next, Ben?
First of all, thanks for having us on this morning from the conference here. Appreciate the opportunity to speak. But look, I think most of the concern around rate increases was digested over the course of the last year. And it feels to us, and certainly the way our markets are behaving at the minute, it feels as if we've reached a comfortable level where the market feels like it has a pretty good beat on the trajectory of rates, how far we've come, and where we might go from here. So we're actually in a very stable period, and particularly if you look back at the last 6 to 8 months and where our asset classes have traded, we've been in a very comfortable trading range, which is actually very conducive, is a very conducive backdrop for new issue if people want to bring new product in either loan or high yield format. The market is actually very receptive, and the investor base seems fairly comfortable with where we are with rates right now.
It is really comfortable. In fact, it's nowhere near the kind of levels of those peak concerns, which you quite absolutely rightly said was last year, really. September last year, for instance, the rates around about 9.5%. We've come off about a percentage point from that now. Ben, I'm going to ask you the question a lot of people are asking. This sector used to be one of the canaries in the coal mine. Is it just being complacent at the moment about the risks of higher financing costs for longer?
It's a super question. I think there are a couple of takeaways there on that. If you're looking at the high yield fixed rate asset class, there's a bit more concern when you look at some of the rates that were achieved in issuance 3 to 5 years ago. A lot of our high yield issuer base was able to achieve rates in the 3s and 4s and 5%. Those same companies, if they come back now to refinance the same credits, will be paying 7 to 9% for their money. So that is a material move for those companies. In contrast, though, in the leveraged loan space, there you have a floating rate component to the yields that the borrowers pay. So in that case, we've already seen most of the damage absorbed when we've seen Euribor go from below 0 to now close to 4%. A lot of that has already washed through. And to date, we're just not seeing the beginning of any kind of material default cycle. Clearly, those increased interest costs and the floating rate product have taken some of the free cash flow out of these businesses, but we're not yet seeing signs of stress. As to the complacency question, I think the investors and lenders that are participate in our asset class, they are well attuned to that, both on the interest rate side, but also in the prior piece, some of the concerns that we're seeing and trying to gauge, will there be a recession in the U.S. later this year, in Europe later this year, or globally? I think there are concerns still around some of the more cyclical companies and some of the most highly levered companies. But outside of that, generically, I think the investors and lenders are fairly comfortable, and that a lot of the rate increase in particular has been digested by the market.
Ben, this is fascinating because earlier in the year, with the implosion of SVB, the market was having the impression that something was broken thanks to the Fed, that the central bank had done it again effectively in terms of breaking something in the system. In your area of the market, are you saying that everything's running smoothly? And if that is the case, what would it take to disrupt the market again?
No, it's again, a great question, and we worry about some of the big macro issues. We've talked about inflation, we've talked about rate increases, we've talked about recession. Obviously, we still have the ongoing conflict to the east here and potential impact, particularly in Europe, on energy prices, which was a big concern last year. But the biggest driver of our market at the minute seems to be the technical balance between the supply of new issue, whether leveraged loans or high-yield bonds, and the demand that is out there on the investor and lender side. And the fact is there has been a huge amount of cash generation in the asset class broadly across leveraged loans and high-yield bonds this year, and there has been a complete dearth of supply to absorb that cash. So as we come into the autumn, we've got a really strong, what we call technical cushion, which is just a lot more demand for our loans and bonds than we've got supply. So until that cash gets absorbed, which at this point there's really no sign that's going to happen based on what we see for a forward issuance calendar, we should have a bit of a cushion underneath us so that if we do get a little bit of a wobble in interest rates, or we get some more negative inflation news, or some bad economic data, there is a bit of a cushion under the market right now until that excess cash gets absorbed.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.